Hey, what's going on, guys? Welcome to the video. It's Chris from Verlo Trading here. We're going to do a video talking about stocks and futures. So in this video, I wanted to go over some details and explain a few reasons why traders would choose to trade futures or why they would choose to trade stocks. So what we're going to basically cover is, the first thing is going to be covering the transparency of the market. Next, we'll be talking about the market participants and the playing field. Then we'll cover capital requirements, and then we'll cover market data, and then I'll just give a brief conclusion. So guys, if you wanted to learn more about trading and some of the things you got to be looking out for if you're going to be trading stocks or futures, then you clicked on the right video. So let's get to it. Smash the like button if you enjoyed this content. Okay, so the first thing we're going to talk about is market transparency. What is market transparency? What I essentially am referring to, the ability to see the intent to trade on the order book, call it level 2, and second of all, the ability to see every transaction taking place in front of your face and at what prices they're taking place at. That's what I consider to be transparency. The thing about trading stocks is that you can have one stock, but it is transacting on a multitude of different exchanges. And that's why whenever you look at a level 2 screen, for example, you're going to see something like this, where you have bids and offers, and each of these is essentially a different exchange quoting the same price as a bid. So for example, 45 and 32 cents, you can see we've got NASDAQ, ARCA, Edge A, Edge X, and MX. So all of those are essentially different market makers or different exchanges that you can route your orders to. So basically the thing is that with stocks, there's a multitude of these mini exchanges that one stock can trade on. For example, we're looking at a ticker AMC in this case, and like we're able to see on this other window here, this is the list of all of the stock exchanges that exist in the United States here. So that's why when you look at a level 2 screen, you can see all of these different names appearing on your level 2 screen. Now, the difference between stocks and futures simply is that futures transact on one exchange. So the volume being traded on a futures contract is all being recorded on one exchange. Normally it's the Chicago Mercantile Exchange. There's also another exchange that exists in the USA called the Small Exchange. You should check them out. So now in regards to stock exchanges and the volume being traded on stocks, when you look at your level 2 screen, you see each exchange. However, when your volume gets recorded, it's all getting recorded onto your chart. So when you see the volume on your chart, that is the total volume that transacted on your stock, right? Wrong. There's also something called dark pools or alternative trading systems. Now you guys should read about this, but basically it's a way for large institutions to transact large blocks of shares without putting them on the order book and without people seeing their orders, essentially. So that's another minus for transparency for stock traders. All right, guys, next part of the video, let's talk about market playing field. I want to talk about market participants and the playing field that we have when we're trading in futures markets or individual stocks. This is sort of a belief that I have, which is that the more hype there is around something, the more less experienced traders will start trying to trade it. And when that happens, normally the more experienced traders are going to be making money. Let me know what you guys think of that in the comments below. But let me explain a bit. It's simply this. So when there's less experienced traders in a market, there's going to be more people willing to buy highs and sell lows. Not to say that buying high and selling low is a bad strategy, but depending on the market and what it's doing, you know, markets ebb and flow, and generally speaking, when you buy on a pullback in an uptrend, you have a better chance of making money than if you buy always at the high of every move. It's not always a fact, but it's just something. So when there's more inexperienced traders that are taking the wrong side of the market, the traders who are more experienced in that marketplace generally tend to be taking the money away from the less experienced traders. So what I'm trying to get at now is that the opportunity in your market is going to depend on who's participating in your market. And that's why I would say, in some regard, trading stocks can have more opportunity than trading futures on certain days and depending on what's happening. And the reason for that is because the futures market is largely dominated by high frequency trading and the liquidity providers, which are basically the big firms. If there's a low amount of participation on a given day, then I would say you have a low chance of making money. Whereas if you're trading a specific stock and it's moving well on the day, and you can tell there's a lot of hype around it, you have a better chance of making money trading that, because when there's more hype around something, when something is moving, there's generally more opportunity. So this just kind of goes into the saying, which is just trade wherever the opportunity is, trade wherever volume is coming in. So I would say there's plenty of opportunity in trading stocks. The only problem is something we're going to talk about later in the video, which is having access to the proper data to trade these things if you're a short-term trader. So, in regards to level playing field, again, stocks have much less transparency than the futures market does. When you see a trade occur on NASDAQ futures, that trade occurred and there was no hidden trades. Whereas on a stock, we could have insiders that have been buying the stock all day through an alternative trading network, and we're not able to see that simply because it was taking place on a dark pool. I don't exactly have a lot of expertise when it comes to dark pools, so what I said might not be true, but since these dark pools exist, I feel like that is removing some transparency from trading stocks in general. All right, so let's talk about capital required to trade in these things. So people tend to trade futures because they have a low capital requirement, and a lot of brokers offer something called intraday margins, which is basically a extremely low capital requirement to put on a position which is leveraged. So for example, to trade micro NASDAQ futures with some brokers, you only need $100 in your account to trade a contract, and for every point the NASDAQ moves up or down, you make or lose $2. Now, for a $100 margin, and if you guys seen how much NASDAQ moves, that's a really leveraged position. In order to get that kind of dollar movement in your account with $100, the only way you can do it trading stocks is by trading a penny stock, basically a stock that is between $1 and $10 normally. So I guess that's why a lot of traders trade penny stocks with small accounts. Now, that being said, some brokers don't offer margin for penny stocks. So let's give an example now. We're going to look at interactive brokers. So I'll just put it in order just to show you exactly what I mean here. So here's NASDAQ Micro E-mini futures. The notional value of my position, meaning the amount of money I'm controlling in my position, is 30 grand, but the amount I need to put on the trade is only 3 grand. So that's how leverage works. Now, the same exists for stocks as well. When you have a margin account, the broker will lend you some cash and allow you to control a larger amount of shares and use less of your buying power. So I'll show you that right here. So look at triple Qs. I'll place a buy order for 100 shares at this price, $365.09. So the value of this trade is $36,500. Now the amount that I need to put up from my account is only $13,759. So you can see here that the broker is only requiring me to put up about a third of the value of this trade. That means I'm getting approximately 3-to-1 leverage when I'm trading this stock right here. And it's going to vary from stock to stock. So now let's go and look at a penny stock here. This stock closed today around $4.60. Let's try submitting a buy order for 100 shares at a price of $4.60. So the value of this trade is $460. And you can see there that the initial margin, the system is not actually calculating it properly here, but it's actually telling me that I need more money than what the trade is actually worth. And that's something a little bit weird. So what I can see from this right here is that Interactive Brokers is not allowing margin on penny stocks or on certain penny stocks. So that's why you should always check with your broker to see if they're allowing leverage on that specific stock. That being said, this stock is an exception because today it was up something like 50 or 60%. So stocks that move 50, 60% on the session, normally the brokers are going to adjust their leverage on those types of stocks. The conclusion here is that the only way to get the same leverage you get when you're trading futures on stocks is by trading penny stocks that move a lot. And the problem with penny stocks is the liquidity sucks most of the time, and they can be easily manipulated by people with smaller amounts of money. So that's why it's a little bit tricky to trade them. So if you're going to trade penny stocks, make sure you're trading stocks that have decent liquidity, where you can see the liquidity first of all, and stocks that have a relatively tight bid and offer spread, so that way in case you have to stop out of a trade, you're not going to get a 10-20 cent slippage on that, and that can happen. So you need to be aware of these types of things when you engage in trading penny stocks. All right, guys, let's talk about market data now and the costs that you will expect to pay when it comes to getting market data for equities if you want to have more advanced trading tools at your disposal, like footprint charts, volume analysis, this type of thing, and also the ability to see the market depth level 2 as well. So what I was able to discover is that right now there's only a handful of unfiltered data feeds out there for stocks that you can get your hands on. The first one is IQ feed. Now, if you want to see what IQ feed looks like, it's pretty much this. So this is Tesla, that someone made a video on YouTube. And look at this data feed right here. Look how quickly it's updating. So if you look at your trading platform and you use, for example, Interactive Brokers or TD Ameritrade, there is not a chance in hell that your data is going to be updating this quick. It's because they give you a filtered data feed of the price. And I don't know why they do that. I guess they do that to reserve computing power. But this is what a true unfiltered data feed looks like, where you're seeing every tick of the price. Now, if you're doing order flow analysis, bid-ask analysis, and short-term trading, I would argue that you need to see every tick. You need to see how the bid and offer spread is being manipulated in real time. If you're not seeing that, you're missing out on a lot of important information, especially if you're going to engage in trading the market right now, trying to scalp it or something. Okay, so there's an example of your unfiltered feed. And if you want to know what that costs, that's IQ feed. Let's just give an example right now. So these fees right here are considering that you're a non-professional subscriber, meaning you're not a member of any of these exchanges or you're not a financial professional of any kind. So we're going to subscribe to NASDAQ, New York Stock Exchange, and New York Stock Exchange American, as well as NASDAQ Level 2 book. All right, let's click next. Let's also add market depth, which is going to give us market depth on those equity exchanges. Let's click next. And IQ feed has a basic fee of $115 a month. I thought it was around $95, but apparently it's more. So basically that's what you expect to pay per month for your market data for your equities. All right, $216 a month. And you're going to be able to use this on any platform that supports the IQ feed for equities data. So that's really good to know because a lot of platforms support the IQ feed. Now, I've discovered recently that there is a lower cost option out there, and it is through Sierra charts. So we're going to talk about this real quick. So here's a video that a trader recorded, and he is looking at equities here using Sierra charts, and this is the Sierra chart exchange data feed. So here he's displaying the stock SPCE, and I believe that this is an unfiltered data feed. As we can see here, we're seeing pretty much every tick that's happening in the price. And I'm looking mainly at this footprint chart here on the left side of my screen. And also the advantage with Sierra chart is that it has some of the best order flow and volume analysis tools out there. And also it's basically one of the most customizable charting platforms out there. It's probably the best, one of the best out there. So there's Sierra charts right there, and we're looking at the exchange data feed that they recently started to offer. So to me, it looks all right. You can look at some other examples of it online, but this is a video I found of a trader who is using this data feed. So this is a lower cost option. The only thing is right now is that this Sierra chart exchange data feed does not have the market depth for the US equities data just yet. I'm not sure if they're looking to add it, maybe they are, but I would say that you do need the market depth to trade this stuff, and the only way to do that would be to get it from another source. So let's give an example now. Let's say you use Interactive Brokers as your broker and you trade stocks. You're going to be able to get that level 2 data from Interactive Brokers. It's going to cost you, for example, NASDAQ Total View, Open View, $16.50 a month for that. And I also think they require you to subscribe to the level 1. So let's just say 20 bucks, because I know the level 1 is around $1 pop or something. 20 bucks to get the level 2 on your Interactive Brokers trading platform. Now let's go over to Sierra chart, because remember, we need that unfiltered data, the good data. We're going to be using Sierra charts to display a chart similar to this. So let's go over to Sierra chart and talk about that. So this is Sierra chart right here. I'm going to link this down below, but they have what they call their Sierra chart exchange data feed, and it offers equities data. So that's how much it costs. For 250 real-time symbols, it costs 25 USD a month. And that's a lot of symbols that you can monitor in real time, especially if you're an individual. So I would say someone doesn't really need more than that. So let's go over to our calculator now. So $20, that's for the Interactive Brokers feed. Now, Sierra Charts costs $36 a month for the package 5 to be able to show numbers bars like this trader is displaying right here. In my opinion, it's necessary if you do any kind of volume analysis. So there's your 36 bucks a month. Now, plus the 25 for the Sierra Chart exchange data feed. And then we need to add our exchange fees, $10.50 a month for the US equities data, NYSE, NASDAQ, and American. Let's add that to our calculator. So you could expect to be paying a total of $91.50 to get all of the equities data you need, level 1 and level 2, and using Interactive Brokers as your broker. Okay, quick comparison to what you'll pay for futures market data. So generally, futures unfiltered data is more common. So certain data providers actually don't charge anything for their data. So all you have to pay is the cost to the exchange for the data. So just an example, there is a data provider that charges $25 a month and you get the entire order book. This data provider is called Rhythmic. Now, depending on which exchanges you subscribe to, you're gonna pay more or less. So if you only subscribe to CME Globex and you're a non-professional subscriber, that's gonna cost you $11 a month right there. So that's what your market data is essentially gonna cost you right there. And then you're gonna have to add any platform fee. So if you use Sierra Chart, it's gonna be plus 36. If you use another platform, let's say for example you use Jigsaw, it'll be 50 if you trade on that. So 86 bucks. You can see pretty close between futures and stocks for market data costs, and this was an example using the $25 if you wanted Rhythmic. So you can see, guys, that market data is expensive, and that's why I think traders tend to want to specialize and trade only one thing, because in order to see the data for all these things, well, you need to pay good money to get the data you need to give yourself an edge trading it, right? And that's how I see it, at least. So there you go, guys. Check out the Sierra Chart exchange data feed. I mean, I might subscribe to it in the future because lately I've seen a lot of opportunity in the equities market. All right, let's do a little conclusion. So futures versus stocks. Why would you want to trade either one? Well, first thing I said was talking about the transparency. There's more transparency trading futures because everything is settled and traded on one exchange in front of your face. If you see a bid of 100 contracts, it's a real bid. And there's also rules against spoofing the order book. It's rare these days you're going to see a huge bid and then it pulls because it was fake. So for transparency, futures win all the way. When it comes to level playing field and market participants, this one is a little bit more debatable. I would say, depending on the kind of environment that the market is in and the kind of participants that have been attracted to the market, there will be more or less edge in that market. And that is why on some days the futures markets feel very manipulated when the liquidity drops off. It's essentially you versus Goldman or whatnot, and you got the HFT market makers who pull their bids faster than you can say bid. And if you're trading in that environment, you have less of an edge, in my opinion. The more less experienced traders in the market, the more edge the experienced traders have. That's just my opinion on it. I could be wrong. So I would say when it comes to having a level playing field, it really depends on what you're trading and the overall sentiment of the market as well. When it comes to capital required, generally speaking, you get the most leverage trading futures or penny stocks. The problem with penny stocks is that the liquidity tends to suck really badly. So you definitely need to have good ways of filtering out if the stock is tradable or not. Generally, futures provide more leverage than stocks unless you're trading penny stocks. When it comes to market data, the cost for trading futures versus trading stocks, relatively the same if you use the example I showed you using the Sierra Chart exchange data feed. Hopefully they include level 2 in the future, but to get that good unfiltered equities data, it is quite expensive compared to getting that data for futures is basically free if you use CQG. I gave the example of Rhythmic, but CQG, depending on your broker, is basically free and it's unfiltered tick data. So there's another example right there. To conclude things, guys, futures are definitely becoming more popular in the retail trading industry. There's a lot of new developments out there, and I do think you guys should check out some of the new products that are coming out that offer ways to balance out your portfolio. So I did make a video covering the Small Stocks 75 index. You should definitely check that out. These are tickers that trade on the small exchange. Guys, this was just an educational video talking about the differences between trading stocks and trading futures. If you found it educational, let me know in the comments below, and we'll catch you in the next one. Take care, bye.